Z Group. He's economist there. And Richard, it's quite extraordinary. Good morning first. And thank you for joining us, and thank you for being part of 18 Now, this program. It means a lot to us. Richard, it's quite interesting that if I look at the general positioning for the US economy, 8 out of 10 economists, or if I may say 9 out of 10 economists, are bearish. But if I look at the US financial markets, S&P has rallied, Nasdaq is nearing at an all-time high, and there seems to be quite a contrast in what currency is doing and versus what US markets are doing. So just connect the dots for our viewers, my friend.
Well, maybe I'd pick the two rather than the one. The dollar's been coming down. The US numbers have been soft. It began in April and May with the survey data, the PMIs and so forth. Over May into June and then probably into July, we've got the hard numbers, which are coming down and validating what we've seen. We've got softer employment growth. The unemployment rate hasn't gone up very much, but that's in some ways a different story. We've got softer headline jobs growth in the US, and the dollar's been coming down for a whole range of drivers. I think part of which is this unfolding slowdown in the US economy. I think that part of the picture to me is pretty clear, and as we head into the second half of the year, I think we'll see the US economy slow a bit more. No recession, but a slowdown.
Richard, financial markets, they always say, are an indicator of what lies ahead. Are financial markets telling us that the tariff concerns which were there in the month of March, April, have they been discounted?
Possibly. They may have been discounted. The rate at which we've ended up with tariffs doesn't look like something which will be, destructive to the US economy or, in fact, the global economy. But they do look like they're going to contribute to higher input costs for US business, and certainly some of that will get passed through to end consumers. That's a key reason the Fed's not easing already. I mean, our forecast for some time has been the Fed would deliver its next rate cut in September, and that's a timing that I feel quite comfortable with. Without the tariffs, I suspect growth might have been a bit better, but more importantly, the Fed would be even more comfortable with the inflation story and probably would have been able to bring the numbers down a little bit more. Let's not also forget, it's not just tariffs we're talking about in the US, but also the one big beautiful bill, which is yet to pass through both houses of Congress, but that seems like where it's going is going to add to the deficit over the next couple of years. So in that sense, is also causing the Fed to stay its hand and be a little bit cautious.
All right, but Richard, help us understand what are you penciling in with respect to the rate cuts? Because of late, the commentary that we are getting to hear from Fed spokesperson, they are saying that the rate cuts are possible later this particular year. A careful and a patient approach is appropriate at this point in time. Help us understand, how do you connect the dots there?
I agree with the Fed. Some rate cuts seem likely. A patient and careful approach seems the right approach when you're dealing with so many cross currents, and in fact the economy is not that weak. So we've penciled in September, December and March for the next 3 rate cuts, and at this stage that's all we have for the Fed. And look, I just like to keep reminding people, particularly on days when the news flow seems particularly poor, no recession. It just doesn't look like we're in for a recession. And if it's a mid-cycle slowdown, that's something that policy can be responsive to. And actually the economy can respond to the rate cuts when the growth slowdown is only modest.
Really appreciate your time. Thank you very much for joining us. As we walk into trade this morning, where is GIFT Nifty? Above